Welcome, everybody, to the Investing with IBD podcast. It's Justin Nielsen here, your host. And joining me as he does every week, it's Arusha Pierce from O'Neill Global Advisors. He's a portfolio manager over there. How you doing, Arusha?
I'm doing well, Justin.
Well, this week we've got a little bit of we time. It's June 14th, 2023, and we just had a Fed meeting. So we'll talk a little bit about the market, but most importantly, the topic of the day is going to be FOMO, fear of missing out. We were before the show coming up with all sorts of silly references and songs that we could have sung and everything like that. Maybe we'll get our editor on here singing some songs for us. I doubt it, but it's always a possibility. But that's going to be our discussion topic because this market has been so strong and for so long was so narrow, it was not trusted. And now, as it's continued higher, a lot of people are like, "Wait, did I miss it?" So we'll talk about that, and we'll also talk about some of the stocks that are on our radar. But let's go ahead and start off with the Nasdaq Composite. Um, we got extended, and then we got more extended. It seems like we were saying extended for a while. And look, I'll be honest, when Wednesday's reversal happened last week, I thought, oh well, this is it. This is the expectation. We're going to come in a little bit, and you look at that point on the chart, and it just seemed so obvious. But then the market came right back, Arusha. So what do you make of the current status?
It's and this market is pure insanity in many ways, right? But these are you have to have a strategy for this type of market. When these markets get going, one way or the other, and we saw that in 2022, they can go down a lot further than we can imagine, and they can go up a lot further than we can imagine. And so, yeah, I think it was completely natural to think last Wednesday when you had that reversal that we're probably coming back into the 21-day moving average, which was a few percent lower, and then maybe settle down, let everyone else who missed out on that first kind of leg catch up. But no, this market, it is it's everyone is just falling over themselves just to try to grab something. And so you do have that kind of FOMO phenomenon going on right here, and almost a panic. And that's what creates these trends and these markets that slowly crawl away, and everyone is waiting for a pullback is still waiting.
Mhm. Well, and especially, I mean, in some ways, you had again a lot of stocks that were sitting out. We keep on going back to RSP, which is the equal weighted S&P 500. That for a long time it just wasn't participating. Now that really changed as this got back above its 200-day moving average line just a week and a half ago. It started looking like a very different market. You had the RSP, the equal weighted S&P 500, participating a lot more. You had the Russell 2000 that started to participate. That got above its 200-day moving average line and started to have some big moves. But what I found interesting too was it started to kind of like do this little bit of disconnect in some ways from the Nasdaq. For example, on that Wednesday when we had the reversal on the Nasdaq Composite, um, we were up 1.6% on the on the Russell 2000. It was like, oh, everything's fine here. Now, the Russell 2000 has been following a lot of what's been going on with the regional banks. So if you look at KRE, you kind of see a similar move there recently. Look, there's a lot of regional banks that are in the Russell 2000. You've got 257 banks in the Russell 2000, and a lot of those regional ones. Um, yeah, I think there's been a lot of mixed messages. It seemed like we were kind of all rowing together for a little bit. Then there was this disconnect, especially on that Wednesday, with the Russell 2000 and the Dow actually up. Um, so with all these mixed messages, what should investors be looking at to really get a sense of, is this a bull market or not?
Yeah, well, I think there are a couple of things that you said there. First, messages, mixed messages. There's a lot of noise out there. Always. There's always a lot of noise. Every week there's something major happening. And of course, today we had the Fed meeting and the Fed decision. But I think over the years, what I've learned, and I in many ways I've kind of learned this the hard way, or had to be reminded of it again this year, is keep things simple. Yeah, Bill O'Neill is an absolute genius because he really boiled it down to a few things to just follow. Look for a follow through day to tell you when the market has a chance to rally, and then start identifying leaders and buy them as they're emerging out of pivot points, right?
Mhm.
And if you keep it at that level, you don't have to worry about all of these other things. And if you had followed that in this case for this year, you would have found yourself just slowly getting pulled in more and more. And initially, it might have just been in those seven stocks or whatever, that real narrow list of leadership that we've been talking about for a while, where it was just kind of the large cap tech stocks. But now it's slowly broadening out. Now you probably have, if you bought a couple of those tech stocks, you might have a little bit more confidence. Now you're starting to get a little bit more aggressive and buying some other breakouts, and things have been started to work better. But it's a process. Uh,
Mhm.
but if you're listening to all of the noise out there, and there's the macro is still terrible out there. There's a lot of bad news out there. If you're listening to all these things, it's very easy to miss out on this type of rally right now, right? And we don't know how long it's going to last, but you're never going to get in at the right time or near the right time if you're not keeping things simple. In the end, what is the market doing? The market is always right. And if you just keep it to some simple rules where you look for the market signal and then let the market slowly pull you in as these stocks are emerging past buy points, that's going to just help you organically slowly increase your exposure at the right time.
Yeah. And I mean, we got to address, speaking of the noise and the things that can kind of deter you, um, we had kind of and mixed messages. We had the Fed, right? And Powell had his conference, and I guess it's one of those things where on the one hand we got a pause, and I think a lot of people liked the fact that we didn't have a hike this time around. It was pretty much baked in. I mean, that those numbers just skyrocketed in terms of it was a lock. Um, but the thing I think a lot of people were uh, focusing on is it being a hawkish pause.
Right.
Like, hey, we're pausing, but we're not done. And I think the statement kind of came through loud and clear. The expectation is for two more hikes, and really trying to tamp down this expectation for cuts. Because that expectation for cuts later on this year was something that has been baked in for a while, and I think they wanted to really kind of get the idea out there that, hey, no, we're still in hiking phase. Maybe at the end, sure, but we still expect hikes. And a lot of people are just asking the question, with all this recession talk and some weakness starting to show up in individual companies, um, you know, is the Fed just waiting until they break something before they finally stop the hiking?
Yeah, I mean, I feel like, I mean, didn't they just break a few things a couple of months back with a number of the banks? So that didn't stop them because
Was
obviously
that
inflation.
enough?
Apparently not.
we,
Uh,
we only broke things in the lobby. We wanted to break things, kind of more in the rooms, so
right.
yeah.
It's hard. It's hard to say, right? Because even though inflation has slowed down, it's still pretty elevated. So it makes sense that they want to kind of leave room to hike more. And apparently, there are a couple of the voting members that were they want to raise three times, and I
Yeah.
think one person wanted to raise four times.
Yeah, it was the 2 plus camp was very large, in terms of the governing body. Yeah.
Right. So yeah, so you have this overhang still, right? And the Fed's still going to be bearish, but in the end, you have to listen to the market, right?
Mhm.
We are in a confirmed uptrend. We have our type of stocks acting well. And if you bought them properly, you want to try to give them a chance. Now, as you're for some of the positions you were up 20% or whatever, like you can feel free to lighten up on some of those. But you though the one thing you don't want to do is say, "Oh my God, I've missed everything.
Hmm.
things have taken off. I just got to buy. I just got to buy something that's really sticking up in the air. That's the one thing you just have to be very, very careful of. But right now, the market is acting pretty well, starting to broaden, and it's been a while. And so you have to kind of, if you have some of those good positions, you have to kind of take a step back and give them a chance to work.
Hmm. Now, let's maybe talk a little bit too about again. There's this whole host of stocks that look like they're coming off the bottom. Some of the beaten down names, some of them still below their 200-day moving average lines that are just kind of getting their traction back. And then you also have these stocks. Basically, if you've got anything AI related to
Yeah,
your name, or your last earnings conference call, you mentioned AI enough times, you're in a whole different category. You're up 100%.
right.
What is it? Nvidia's up like 200% almost. Palantir up well over 100% for the year. So there's this whole segment that has been doing something very different. And again, when we talk extended and we look at the Nasdaq and we look at these stocks, those are extended, but yet some of these others are just starting out. So how do you kind of manage, like if you missed where the mania was, um, is it too late? Or, how do you kind of maneuver through that?
Yeah, well, just for compliance reasons, I do own Nvidia.
Hmm.
Um,
As do
but
I. Yeah.
but you know, I don't own enough of it, right?
Yeah.
And
Yeah. That's
it
that.
drives me it drives me
I'm right
nuts.
there with you, buddy.
Yeah, I mean, it drives me nuts because I did get in at a good time, and a lot of these things that we've been talking about in this segment is, I didn't give it enough time to work, and I got out of it, and I was like, oh, I got to get back in, and all this kind of stuff. But there comes a point where, okay, if you missed, and we would talk about this, Justin, in the when we did the seminars around the country, the trading summits, where when you have and when you have a follow through day, and it could be potentially a turn and a beginning of a new bull market, and once again, we don't know if it necessarily is. It kind of feels like it, but we don't know for sure. But things are acting well, but a lot of times there's that window where it's 3 to 4 weeks where you have an opportunity to get some of the very best stocks and some of maybe the potential leaders in the next bull market. Now, if we're past that window, so if you're still underinvested, which is completely normal, I think that makes complete sense right here. Now you kind of have to go down to the tier two stocks,
Mhm.
or maybe even the tier three, because the tier two have kind of taken off
Right,
too,
right, right. Yeah.
right? So you still have to be disciplined. You still have to manage your risk. That's always the most important thing. You have to manage your risk, buy properly, either out of a base or on a pullback to a major support area, and then work with those kind of stocks and maybe a smaller amount of money, and wait when the opportunity comes, because it doesn't matter how great these stocks are, they are all going to come in, and they're going to come in hard at one point, and they're going to give another opportunity. Once again,
Mhm.
if this is the beginning of a bull market, there's going to be time, right? On the average, bull markets last 3.5 years. So there's going to be time to get into some of these great stocks again, but just be disciplined. Don't let your emotions get the best of you, where you're going to do the wrong things. You'll buy extended, you'll get shaken out. I've done it countless times.
Right.
And
Mhm.
it's in the end, it's never worth it. You may get away with it a couple of times, but usually you won't. You get shaken out at the wrong time, and then the stock takes off without you, and then you can't get back into it again because you're kind of dwelling on how much money you lost by buying improperly.
Mhm. Yeah. So when we come back, we're going to talk a little bit more about this idea of FOMO, not chasing, sticking with the rules, and all of the things that you need to do to be successful, no matter what kind of market you're dealing with. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen related subthemes.
With clean hydrogen based energy expected to grow 5 times in the next 30 years, companies building hydrogen related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Piras from O'Neill Global Advisors. He's a portfolio manager over there, and we were talking about this market. And again, we got we just had the announcement, not too long ago that hey, the bull market is back. We're more than 20% off of our lows, and for a lot of people, that might have kind of struck them as odd. For some people, you've been like participating, and you're like, hey, I've been doing pretty good for a while here in stocks like Meta platforms and Nvidia and Apple, which those are all at highs, and then there's others that are kind of looking at the attractiveness of yields going up, and they're just like, well, why don't I park my money in treasuries, because getting 5% sounds pretty good, and not something I have to worry about, especially after a 2022 where things were down so much. So again, there is kind of, depending on what you had in your portfolio, you might be viewing this market very differently. But for those that are like looking at it and are kind of like stunned at how strong it's been, I think there is that, I guess, desire, the fear of missing out, the strong urge to be doing something, be buying, because you're just seeing all of these stocks pass you by. So, what do you do to fight that?
You really have to have a plan, right? I think that's the biggest thing. You have to come up with some kind of plan. And you mentioned a number of different strategies there, and they're all fine. I mean, the first thing is, figuring out a strategy that works for you. And it doesn't necessarily have to be the strategy we talk about here a lot. But there has to be some kind of plan with some guidelines to help you manage yourself. Because if you let yourself get out of hand and you let your emotions dictate your decisions, you are going to do the wrong thing. Now, as we saw in 2020, sometimes you get away with it,
Yeah.
and you can make a lot of money in those times. But I guarantee you that a lot of those people who were going off emotions in 2020, if they didn't have a plan for in 2021 and 2022, they probably gave a bunch of that back, right? They
Right.
probably didn't hang on because that's just human nature. That's what everyone's going to do if you don't have a plan, if you don't have a reference. And that's really why we use charts, right? It gives us an idea of where the market is. And then, of course, that's why we have all these rules to help us manage ourselves.
Well, and I would argue that the other side of that was true too, because on an emotional level, when the market did have its fall through day in April, that was a hard one to stomach. That was a hard one to believe would turn into something like that. And, yes, in hindsight, it's easy because you're like looking at all of the stimulus that came in and all of the money that was being pumped in and everything like that. And it's like, oh, of course that's what was going to happen. But at the time, we were dealing with this huge uncertainty of the pandemic. And then we get a follow through day, and you want me to invest in like this most uncertain times? I mean, in April, we didn't have a test, we didn't have a vaccine, we didn't have knowledge of how bad this was, we didn't have numbers, so I think there was certainly a lot of uncertainty there. But as you said, Arusha, the chart was showing you something very different than what your emotions might have been telling you.
Well, I think this is why this is the beauty of the fall through day, because the fall through day, it's a simple rule, and now it's if you try to learn how to interpret it those first few times, it's very confusing, right? It's
Mm.
but once you get it down, or just read IBD, and they'll tell you when you get a fall through day or not, and when the market's shifted back in an uptrend. Um, it's going to get you in at a time where there's a chance the market goes up. It's not guaranteed. As we saw in 2022, there can be a lot of false fall through days. But
Right.
what I like about it is it's going to tell you, okay, the odds are a little bit higher now that the market could start to rally here. And it's simple enough now where you must look for something to buy. And if you start seeing a stock breaking out that has the characteristics that we look for, You take a shot and see what happens. A small and you buy a small position, something to actually put money to work, because once you put money on the line, that's where the emotions come out. That's where you get the feedback. And that's why you have all these rules to kind of manage yourself, because everyone gets very emotional once you put money on the line in the markets.
Hmm.
So what I now if you're just a chart reader, if you're a technician, uh, it was very natural back in April of 2020 to expect that, look, this is a V-shaped recovery. It's going to run up to the 200-day moving average and probably come back down and come pretty close to those lows, right? Or just come back in a little bit, test the bottom, and then maybe go sideways for a while and then take off. But the markets don't care what should happen, right? The market's just
Right.
going to do what it does, right? So that's why I love the fall through days, because they're simple enough that it are going to trigger at some time, and so then you just kind of slowly get pulled in, just like in 2020. Same thing has kind of happened this time around, and it's been, I think, a little harder, Justin, this time, because we had so many failed follow through days,
Yeah.
right? Which are, so I want to say maybe 6 or 7 over the last 18
Hmm.
months or so. Um, but
Which is not unusual for a bear market.
that's completely average, right? But after you get worn down by these
Yeah.
follow through days, you start losing faith in them, right?
Hmm.
And you start out, it's going to be another failed follow through day and all this stuff. And that's completely human nature too, to do that. But you have to try to shift that mindset and get some money to work to slowly snap you out of it. Maybe for some, they'll snap out quicker than others. But uh, really, this market has kind of dramatically turned, I think, in the kind of behavior over the last month or so,
Hmm.
where now it kind of looks obvious in hindsight. I have it right here, the Nasdaq on a weekly chart, and really, when you look back a couple of months ago, it looks pretty obvious that, wow, yeah, the character of the market really kind of changed. The Nasdaq put in essentially a cup with handle here, and it got really tight. Yeah, it's completely normal for it to go up. But the problem is that after you go through 18 months of getting whipped around and having a number of failed follow through days, it's much more natural to think that it's probably going to fail and come back in, right?
Hmm.
But the reality is if you had some money at work, and you didn't have to have a lot, but you had some money at work, you would have started to see that, hey, you know what? Some of the stocks I bought are actually making progress, which was a different type of behavior than what we've been seeing for the last couple of years.
Hmm. Well, and I think it's important here that what you did was you looked at a weekly chart. It is a very different perspective sometimes when you look at that weekly chart. And again, that tight action that you just pointed out becomes a little bit more obvious. But when you were actually going through it in April, keep in mind we still had the noise, as you said, the bank failures. Are there going
Yeah.
to be more? What happens as you turn over more rocks? Are there going to be more ugly creatures coming out from under these rocks? Um, that was going on. And certainly I think one of the things that was interesting about this follow through day, we had the follow through day. March 29th was our most recent one. That's the rally that we're going off of. We didn't go up immediately. April, a lot of tight action first. And it was also, it seemed like for a while there you had this follow through day in the Nasdaq that was working, but it wasn't the same for everything else. Let's go back to January 6th follow through day.
Yeah.
That seemed like everything was participating, right? It was a very strong rally, seemed like this is the start of something big. And then 1 month later, February 2nd, everything's kind of topping and at the same time. So markets were a little bit in sync. So I guess that out of sync, the divergence, um, you know, does that ever change how you handle a follow through day when you've got something where the follow through day is here, but gosh, it's not over here. I mean, heck, we still have the Russell 2000 below the 200 day.
To a point, it does. I mean, it might make me a little bit more cautious. And I remember even this time around, like thinking that, I mean, really for a bunch of this year, thinking like, oh, you know what? It's only the large cap tech stocks are participating. And I remember just telling others, that, oh, well, then just buy the large cap tech
Right.
stocks.
If
But
that's
but
what's
yeah,
working.
yeah, but I didn't. It's not. I only bought some of them, but now I wish I told myself to be a little bit more aggressive at that time. Like, just buy all of the large cap tech stocks, right? Because those you mentioned it, like Meta and Netflix and all these stocks, they're working really well right now. I was still kind of spreading around, looking for some of the newer ideas and all this kind of stuff. But uh, so you have to kind of play the market you're dealt and given, right? Versus the market that's kind of the ideal one. And so it goes back to, look, if you have a follow through day, you start seeing stocks that are breaking out, try those stocks, right?
Mhm.
Don't worry about all this other stuff. And if you're a little bit concerned that it's not a lot of broad participation, fine. Just go in smaller. Maybe instead of playing 100% of your money, play with 20% of your money, but have something
Mhm.
in the markets, because it's always what I've found over the years. It's always that money that I've had, the small amount of money that I've had in the markets, that's shifted my mindset,
Mhm.
where I've been completely bearish and thinking things are never going to go up to it can happen in a couple of days, where all of a sudden you see some of those stocks that you've bought, and it might not even be a big position, but all of a sudden you're like, wow, I'm up 10% on this in a short amount of time. And it's like, and then you start seeing another stock break out and another one and another one. And that's might be over a couple of weeks, and you've tried those and those all start working. It's weird, but all of a sudden your mind shifts starts to change, and you get a lot more confidence. And
Mhm.
this is all, yeah, the rules are there, and that's all simple. And that's like 10% of the game. 90% is psychology, right? It's getting yourself to
Following
follow
those
those
rules.
rules, right? So it's that shift where all of a
Mhm.
sudden it's like, wow, things start to feel better right now. Now, I've had that kind of feeling. Now, it's this one has lasted a little bit better, and I have a lot more more confidence this time around. But there were a couple other times over the last couple of years I had that. The first was right at in March of 2022, right at the top there. I was starting to feel like, wow, this is starting to feel pretty good, and
Right.
then all of a sudden the markets collapsed, and then really around that August time where things were starting to work, and then even the February time that you mentioned, Justin, where
Mhm.
things restarted getting, and then it kind of collapsed. So this could still come in pretty hard. It still could collapse. Anything's possible. And if that happens, then you back away, right? You cut your losses or you take your profits, and you might not have as much profits as you might have now, right? And you back away and let the market set up again. But
Mhm.
this is kind of the process. It's tricky, but in many ways I feel like this is our type of market right now. The markets are starting to broaden, and I feel like for the first time in a couple of years, maybe the markets are acting better than they have during that time period.
Right. And a lot of that has to do with the feedback, right? You're,
Right.
as you said, you start having things kind of work for you, and that allows you to put more money to work. So again, it really does kind of come down to starting right. So I guess if we're going to talk about your rules for fighting FOMO, the first thing you need to do is start right, and that starts with the follow through day. Now, once you've gotten a little bit of time under your belt and you can see what the market is telling you about the follow through day, and granted this one took a while, right? You had March 29th, and then you had a pretty decent kind of pullback in April, at the end of April, and then in the beginning of May, and so you had these kind of pullbacks that were enough to maybe shake your faith a little bit, but they also gave opportunities, some of these pullbacks, to buy a little bit more if you so chose. So I guess there's that component is the kind of proper way to do it, and you slowly build your portfolio size and exposure up. But and look, I'm guilty of this myself. There's a lot of stocks that I started with these small positions, these probe positions,
Hmm.
and then when they really started ramping up, I'm like, oh, I don't have enough of it.
Yeah.
Nvidia, for instance, and so then I'm constantly fighting this urge to not chase it, not get my average cost up too much, but at the same time, put more money into what is obviously one of the big winners of this market.
Yeah, it's funny. Like I have, I've been able to get in some of these stocks that have done pretty well, and like you, Justin, like you never have enough. And while I remember just like even a couple of weeks ago when these things are working, it's like things are working finally, and you're starting to see some progress. And it's like I was miserable. Yeah, I was just like everything is like I'm making money and I'm miserable. And
That's
that's
not
the
enough.
because and that's the one thing that I've learned over the years. You're going to be miserable. You're never going to be happy in this. So follow the rules, yeah, and you try to be as disciplined as possible and try to make money, right? And the next time around, you'll get better at it, or maybe you'll stumble, but you're never going to be happy in this. The moment you are happy in this, you probably should sell everything because things
Right.
are working way too well,
Yeah.
right? And it's the kind of the yacht test, right? If you start thinking, hey, you know what, maybe one day I'll be able to afford a yacht, just sell everything because things are working way too well at that point.
Mhm. Well, let's before we kind of top off this topic, let's talk about one other thing is, if you are still on the sidelines, and as you said, look, you've got time, these do play out over years, not days. So if this is a market where we're at the beginning stages, what's kind of the way to increase exposure by following the rules, by being disciplined and not succumbing to FOMO? What's the proper way to get more of that exposure in if this market truly does work?
Look for some stocks that are forming bases right now, right? There's always kind of a set of stocks. The best ones have taken off. They took off months ago. They're off and running. Then the next set took off maybe a couple of weeks ago, and then third set's probably setting up right now. So you can look for some of those stocks, try a couple of those, and see how well those work. You don't necessarily have to be super aggressive, but start to try to get traction. Just getting that traction can help build your
Yeah.
confidence. The other thing I would say is, and these markets are going to pull back, right? And they'll probably pull back tomorrow, right before you listen to this podcast, and you're going to be wondering what we're talking about. We're recording this on Wednesday after the close, but these markets are going to pull back. They're always going to give you opportunities, right? But you have to have that right mindset, because
Mhm.
every time I've been waiting and begging for the market to pull back, or the best stocks to pull back, when they do pull back, I don't want to buy them anymore, right?
Yeah.
Because you're like, forget it, I don't want to buy them anymore. So you have to be just
Especially if
kind of
there's a news event that is like kind of, coming out that makes it, oh, well, now things are bad, kind of thing.
right, exactly. And we could have that. We're just we're in the middle of June right now. Yeah, and from mine, this is anecdotal, but from my kind of experience, July's generally been a pretty tough month for
Yeah.
me,
Hmm.
where a lot of our kind of stocks do come in pretty hard and shake you out, and it looks terrible. And then August they kind of build bases, and then mid September they complete them or something, and then finally you end the year strong. Maybe we're in that kind of phase, but we're going to have a really it's going to come in hard again, right? The markets are never easy. They're going to come in hard. You have to prepare for that. If you caught a bunch of if you played this really well over the last couple months, first, well done, but don't assume that it's going to keep acting like this too. Look at some of those stocks and say, what are my leading stocks? What are the leaders that I really want to do everything I can to hold on to them?
Right.
And then for the other stocks, maybe cut some of those, right? Or maybe take some profits, partial profits at least, right?
Hmm.
So that's kind of the thing you don't want to just go, I'm making money now, I'm 200% in, I'm all margin, and this thing is never going to keep stop going up, right? You even if you had like the very best stocks in the market, you want to be careful of getting too top heavy, as Justin was talking about, and going on margin and getting yourself in trouble, because you could lose that very, very quickly in just a couple of days. You could
Yeah.
lose all your gains in a couple of days very fast. There could be
Hmm.
another crisis. There could be something which could really, in many ways, be a normal pullback in the market, but
Yep.
it could be a very severe pullback. So in the end, it's being disciplined. Try to get some of those tier two, tier three stocks that are merging out of bases, and then I think the other thing, Justin, is look, maybe you just buy a couple of ETFs
Yeah.
in
Mhm,
some stocks. I mean, in some, like maybe the IWM that you mentioned,
mhm.
or some other one that's near a support area or emerging past a pivot or some resistance area, that you can first manage that, get some exposure, and then once some of the better stocks move back, or one of the stocks that you've identified that you really want to get into, once that gives you an opportunity, you can move out of the ETF money and put it into one of those leading stocks.
Yeah, use the ETFs as a source of cash. And one other thing, because you keep on talking about these, tier one, tier two, tier three stocks. Mike Webster used to talk about grading his stocks, and
Yeah.
and you could do that for really kind of all the stocks on the market. There are certainly right now a whole host of stocks that I think a lot of us are looking at as, hey, these are the leaders. Maybe you caught some of them, maybe you saw some of them go by, you didn't believe it, and now you're just waiting for the opportunity to get into them because they're so strong. And in hindsight, it was easy, right? And now you're at a point where don't let these fall off your radar. You should be watching these, waiting for those opportunities to get into them. And yes, maybe you're getting a tier two or a tier three stock in the meantime, taking some, smaller gains from those, and using those as your source of cash when maybe that tier one stock gives you another chance at getting into it, because they they always they always give you a chance. A lot of these greatest stock market winners do have their pullbacks, and again, it's scary when it happens, especially if you're in it at the time. It's a lot easier watching from the sidelines than when you're in it, right?
Yep.
A tight action, you know, when you're in it, feels like, oh, my stock isn't going anywhere, I chose poorly. When you're not in it, it's like, oh, look at this tight action, this is perfect. It's giving me a chance to buy it. So yeah, the
Yeah, and
perspective
and
changes different.
Justin, well, and you mentioned, yeah, like AI and stuff like that, and I do, and I've seen plenty of people talk about, like, oh, AI is a bubble and all this stuff, and it
Mhm.
might be. It very well could be. I mean, it really kind of seems like there is a kind of big catalyst out there with Chat GPT
Yeah,
that really is going to change. So that part makes sense to me. But it could be a
and
bubble.
it seems early too.
It seems early, but it could
Yeah.
be a bubble. Maybe this is, well, a quick run up. Like, to just keep an open mind, it could be a quick run up like the cannabis stocks
Right.
from like 5 years ago, and then everything comes in really hard.
Mhm.
That is definitely within the cards. But that being said, even if it's a bubble, if you have rules, you can do really well in bubbles.
Yeah.
I think that's the one thing that, yeah, just because the bubble doesn't necessarily mean that you have to avoid it. If you're buying properly, if you're disciplined, if you're following rules, you can do really well in bubbles. 2020 was a total bubble, right?
Mhm.
But you can do very well in those type of bubbles. But when the party's over, you have to be willing to get out and get out fast.
Yeah.
I think that's the real key here. So just because you're hearing everything's a bubble, yeah, I feel like almost the whole system has been really does well when you have these kind of quote unquote bubbles, because that's where everyone starts to have that FOMO. They really pile in, and that's what makes some of these stocks that are really game changing type of stocks start to go vertical into the moon.
Yeah. And it's worth noting that you know I can't think of a better example than the irrational exuberance speech,
Yeah,
that Alan Greenspan gave, that really kind of summed up what was going on in the 90s. And what a lot of people have to remember is that speech was given at the end of 1996.
right, right
So
around here. Yep.
it got so much crazier. So a lot of times when people say bubble, that it's not necessarily, it was all can always get bubblier. So just keep that in mind. And as you said, Arusha, that's where having rules to get you out properly, where charts can help you manage your emotions, because you're looking at facts of what's actually happening, the supply and demand that's going on in the market every day, as opposed to what people are saying, and that's when people are putting their money where their mouths are. So it doesn't mean it's not a bubble, it just means that there are ways to handle it. So very good points, Sarusha. When we come back, we're going to talk about some of the stocks that are on our radar, maybe some of the tier one, tier two, and tier three stocks. So stay tuned, we'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen related subthemes. With clean hydrogen based energy expected to grow 5 times in the next 30 years, companies building hydrogen related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with a portfolio manager from O'Neill Global Advisors, Arusha Paris, who joins me every week. And let's talk about some of the stocks. Certainly there's the big cap techs that have kind of a lot of them have made their moves, but let's maybe talk about some of the stocks like Chinese stocks that have come on a little bit more, gaming stocks, and if we want to kind of merge those two together, we can look at Netease. Netease is something that I noticed had a pretty decent move today, and China was for a long time kind of on the in the penalty box, if you will, since we just finished the Stanley Cup finals. But what do you think of this now? Is it okay to invest in China, or is it still a risky proposition? And what about something coming out of a base right now instead of being completely extended and out of there?
Yeah, I think in many ways it comes down to the stock itself, right? So is it so really getting down to the question, is it okay to invest in China? Look, if there are some stocks that you like that are breaking out of bases, take a shot, manage your risk, and see what happens. I think in that way, at least you're taking some shots, and some of them will end up working, and you'll end up finding yourself in some good stocks, maybe in some Chinese stocks that end up working really well when China is okay to invest, right? The market will tell you what's right or wrong, but it's up to you to manage that risk and really follow that plan. So with Netease here, uh, now really going back to some of the topics we were talking about, I think in the previous segments, Justin, where what do you do now if you're not heavily invested in the markets and stuff like that? You're looking for those other types of stocks. Now, we were putting in tier two, tier three stocks. Yeah, maybe some of them might be actually really good companies. It just might be more a function of the rotation.
Yeah.
The one thing that's been consistent over these last couple of years is these markets love to rotate. It seems like every 6, 7 weeks, when you think that you're in the right stocks that are going to trend really well, the market suddenly changes and they rotate to another set of stocks that are just breaking out of basis. Then they go on a pretty good run. Think about like the staples and the healthcare stocks that were all the talk of the town 2, 3 months ago, right?
Mhm.
So now maybe it is China again, like you said, Justin, and NetEase might be telling you that maybe it is those gaming stocks. So the facts are, and you don't have to always worry and completely know every aspect of whether China's good to get into right now or whether even gaming stocks are good to get right now. You just need to know that, look, do I like NetEase? Are they growing? Is this a company worth investing? And is it actionable at this point? The reality is that it is actually actionable right now. It is 4% away from the pivot, so it's starting to get a little extended. So you might not want to be as aggressive and hope for more of the pullback to continue to build position. But this stock is actually trying to break out right now, and it broke out yesterday, and it moved up today on actually some decent volume, up 46% out of this flat base here. So here is a stock that if you like what they're doing, if you like the fundamentals of this and you like the story of the company, it's an opportunity to put some money to work in this stock.
Mhm. Now, one of the things that we've got to mention, because a lot of the stocks that we're looking at, the price action is good, but the earnings part is a
Yeah.
little spotty, right? So we had a really bad quarter a couple quarters ago. The sales, the revenue, we got some red there recently, and this is not unusual. I'm not picking on Netties here. This is something that we're seeing in a lot of stocks. Some of them with the best price action out there. So how do you kind of look? I'm a cancel 'em kind of guy, but the stuff that's working isn't always congruent with the earnings that we're requiring.
Yeah, this is where it gets really tricky because we've been in a bear market. Maybe we've come out of it. The reality, and or maybe we very well still could be in it, right?
And we still are looking at a potential recession, soft
Right.
landing maybe, but something is looming out there.
Yeah, and the Fed still theoretically could raise rates more. They want to raise it 2 more times. So there are a lot of headwinds still. And as a result, with the slowdown in a number of different industries, you are going to have plenty of negative numbers right now. So it does get trickier. And so I think you have to take that into account. You might not necessarily find the some every stock's going to be perfect. So if you find some that do match more of the canceling characteristics, then and you like them, then yeah, then maybe move those up in the priority and try to get into those first.
Mhm.
But if you're looking for some other kind of quality stocks to get into, and you're familiar with those stories, and they don't have everything perfect, you still can take a shot at them. You just have to manage your risk. And a lot of times, if they're not perfect, uh, I might just not go in as aggressive, right? I might reduce my position, which is another form of risk management there. So instead of
Yeah.
maybe starting out with a 10% position, I might start with a 5% position, and just play with smaller positions to see if I can get some traction there. I think really getting back to that question of what do you do if you're not invested in the markets right now. First step is really try to get in some decent stocks and try to shift that mindset, that psychology, and try to get some confidence in the market where you're able to make some progress in the market, right? And then slowly move into some other stocks, and now you can get a little bit more aggressive in those if they, especially if they have some better qualities. So it really is a process. So Netease, here's one that it is breaking out. Maybe China's coming back. Maybe the market starts to rotate in some different areas versus kind of the AI stocks. And all of a sudden, maybe you find yourself in that next kind of rotation.
Mhm.
Uh, so this is an opportunity. Now, one other thing, Justin, that you mentioned, and we were talking about this before we started this segment. I want to say this is the first time in probably 2 to 3 years that I saw at least some of these gaming stocks
Right.
start to show up on the radar, show
Yeah,
up on
Take
some
Two
screens.
Interactive, ticker TTWO. I mean, that's one that started looking very different. I mean, it's got a number of 3 weeks tight recently. Um, yeah, I mean, this is not one that we've been looking at as much lately, but all of a sudden it's starting to climb back up.
Yeah, and it's still plenty of work that it needs to be done, but maybe you're starting to see a potential character change in the stock right here, where it had the earnings gap, 12 million shares came in. Maybe it's starting to put in that bottom, starting to slowly build the right hand side, and start to trend higher here. So I thought that part was really interesting. Now, back in 2016, 2017, Take Two went on a great run. And because of Grand Theft Auto and some of the other
Mhm.
games that they have. Maybe they have some new game coming out, or maybe the new Grand Theft Auto game's coming out or something. But it's when it's this might not necessarily be buyable at this point, but a lot of times when I see kind of reactions like this, it's a flag that okay, when I have some time, I should read up on this area to see
Yeah.
like maybe there's a new console coming out, maybe there's some new catalyst coming out that's going to drive and increase the revenue and earnings for these companies.
Yeah, absolutely. So, definitely be aware when you see more than one, you know, uh, just make sure there's something, what's going on there. Is it regulated to just one company in that group that's driving all of them, or is there something really industry wide going on? Speaking of industry wide, another area that really seemed to kind of come up quite a bit is the airlines. So if we take a look at, for example, UAL. Now, for a while here, I was really just looking at the discount guys like Ryanair and Copa, CPA. Those were just looking very different. They were looking much stronger. But now, the old guys, the big guys, United and Delta and those have seemed like they're coming out a little bit stronger. And so, you know, this is where I get a little nervous. Okay, you get a move like this, and granted, look, United is not going to be a earnings, you know, behemoth, but you have a lot of weeks up in a row. You had this kind of really sharp break for 3 weeks, this really gradual move back up, and now we're kind of at that old resistance levels. This is usually where I like to see a pause. So, um, but sometimes they don't, right? Sometimes they just go through the cup and never form a handle. Uh, how do you handle stocks like this?
Yeah, I like you, Justin. I want to see that handle to have a little bit of a shakeout here and set up again and take a little bit of a break. Um, so usually the way I handle it is how badly do I want to get in the stock, right?
Mhm.
If it's a stock that say it's United Airlines and it breaks out without forming a handle and runs up here and over the next couple of days past the pivot, I'd probably pass on it. But
Yeah.
if it's a stock that I think is the next great leader in the market, I'll probably take a shot at it, right?
Mhm.
So for the most part, 95% of the time, I'm going to pass on it. But if it's one, there are some great stocks that they're just going to take off, right?
Mhm.
I think the classic kind of cup that took off early on in when it was trading was Google, where it just took off and it didn't
Never
take
look
a
back.
time to form a handle and never look back, right? So
Mhm.
so
But it definitely had that end factor, right? The new,
yes,
okay, this is and a dominant position, you know. United, sure, maybe there's a new condition in the industry with this pent-up demand for travel, exploding this summer. And, I mean, hey, look, I'm jumping on a United flight tomorrow and I'm going to Europe. So I'm going to be out for the next couple weeks. You're going to have some guest hosts. But that's it's one of those things. There is something going on there, but is it as revolutionary as Google? Probably
right. And that's usually those are the questions I'm asking myself, right?
not. Mhm.
And so something like United Airlines. Now, the reality is, it, I'm gonna have to be really looking for some stocks to buy if I'm gonna get into United Airlines because it for the most part it's an airline, it's an older airline. Just looking at the weekly chart here, they generally like to go in a trading range that goes sideways for most of the time.
Mhm.
So I'm not necessarily these aren't the type of stocks I'm going to generally get into, but if it is a stock that I think is a game changing stock that owns the market, kind of like Google back in the day, and that breaks out, yeah, I already know over history, over the experience that some of those stocks they just take off and they don't come back for a long time. So you better take a shot when you have it. But
Mhm.
yeah, so something like this if you're really looking for a stock, if you want to get in a little bit slower moving stock, maybe it's the larger airlines turn to slowly move up. It's very possible that they can go on a decent run,
Yeah.
right? I almost like I mean I want to say like even the casinos, right? They went on a decent run over the last year or so, right?
Mhm.
Like Las Vegas Sands, like coming up or an MGM, right? I mean, some of these companies, well, maybe not MGM, but yeah, I mean, back in 2021, they went on a decent run. So uh, there are some of these older stocks or older companies, good brand names that also the market will start going towards them, and so why not for a United or some of these airline traditional kind of airlines versus some of the newer ones?
And again, maybe you don't treat it like, oh, this is going to be my big winner of the year, but maybe it's more of a, oh, maybe I get a 10, 15, 20% gain and then I'm happy with it and I move on to the next thing.
Yeah, it's a
No,
confidence builder, right? It's like
yeah,
let me get some
get that
wins under my
traction.
belt. Yes.
Get some lift in my wings, if you will. One of the stories though that we have been talking about is this use of diabetes drugs for weight loss, and this is something that certainly has big ramifications for health. Given the talks of how much of a health risk factor obesity is and how widespread it is. So talk about a large total addressable market. And Novo Nordisk, I'm going to be traveling. I'm going to Denmark, so I don't know that I'm going to be necessarily knocking on Novo Nordisk's door, but this is a Danish company, and of course they have a number of different, you know, different drugs, different drug names. But the big thing here is that these are really kind of having an effect for weight loss. And this is one that I think a lot of us were looking at. Oh, we're looking for that chance to get in, and lo and behold, here we have a flat base. Is this? It's down below the 50-day moving average line right now, down below the 10-week moving average line. But is this potentially the chance to get in?
Well, maybe not necessarily the chance to get in, but the chance to add it to a watch list, right?
Hmm.
And watch it very closely. Let it get above the 50-day. If you want to buy as it gets above the 50-day and that works for you, then maybe that's the first initial opportunity, or you can wait for the breakout out of the flat base. Now, out of the three stocks, or kind of the three key stocks, we looked at a few more in this segment. This one is probably the closest one that matches what we look for from an O'Neill perspective, a Can Slim type of perspective. Now, this is a bigger company though, which is kind of interesting. A lot of times we're looking for newer companies too, but there's a $357 billion company here, but EPS rating 94, composite rating 99, relative strength rating 90. It actually has a really nice prior uptrend. Back in 2021, it went on a really nice run and then consolidated and broke out a consolidation that worked really well. Accelerated earnings, accelerating sales, right? Fund ownership starting to increase here. It looks like a number of the industry group members, their relative strength lines are pretty good, right? So if you're going back to Mike Webster grading a stock, he's probably going to give it this one a B plus or something, I would guess, where it's starting to tick off a number of the things that we look for. It's not perfect, but it has less flaws than a number of the other stocks that we were looking at. So I think this one is worthy of a watch list, worthy of reading about it. And Justin mentioned some of those catalysts. They do have a potential new catalyst here, and as we have seen in end of 2022 and the beginning of 2023, this is done really well too. This is one of the better acting stocks this year. So
Right.
yeah, I think it's worth keeping an eye on. Now, one kind of negative thing is that relative strength line. Ideally, you want to see that stop going down here, and if it starts to break out, you want to see that getting into new highs.
Yeah. Yeah. So definitely with the market having gone up as much as it has and this taking a break, it gets back to that rotation thing that you were
Yeah.
talking about. And sometimes that can mess with your relative strength lines a little bit. I mean, I remember when Apple came out in 2004, its relative strength was horrible, right? Because
That's true.
what happened in
Yes.
2003? This roaring market coming out of the bear market, and Apple was basing during that time. So when it came out of its perfect cup with handle, the relative strength wasn't that great, but it was a rotation play. And there were a number of these stocks that were coming out in 2004 that were kind of the next batch of stocks that led the market. And then Google that you mentioned, that was a little bit after that, right?
Yes.
As an IPO. So definitely worth keeping your eye on. So that's going to wrap it up for us this week. And as I mentioned, I'm going to be on vacation for a couple weeks. So Scott St. Clair will be back in the chair, guest hosting, along with Arusha. And then after that, Ken Shreve is going to take a turn as a guest host. So you've got some variety to play around with.
Don't
But
stay away too long, Justin.
right, don't stay way too long, otherwise I might be out of a job. So hope you enjoy the next 2 weeks without me, and we'll see you next time. Thanks for watching.